Buy-to-let mortgages have been around for a long time, and they've driven the marketplace for the private rental sector, which of course competes with people buying their own property. And there's nothing wrong with that at all. People need good houses to live in, and landlords have spent money on houses, done them up, and there's a really good private rental sector in this country. But the people that buy these properties and rent them out, landlords, are investors. They're business people like everybody else. They're looking for an investment. So what they're now thinking about is, do they want a buy-to-let mortgage? In other words, a rental property, or do they put their money into shares? So there's the question now to think about, because it's not so popular now to have buy-to-let mortgages. They were very popular, of course, in the early noughties and the teens, as we call them, because interest rates have been really low, even buy-to-let mortgages. But the tax started to change in 2016. Tax changes came in which diminished the fiscal benefit of a buy-to-let mortgage, particularly for people who only had one or two properties. And part-time landlords kind of pulled out, really, didn't they? And left it now to professional landlords who have a number of properties in their portfolio. But they still need to look at the pros and cons. Do they put their money into buy-to-let housing, or do they put their money into shares? So let's take a look at the pros and cons then. So let's take a look at buy-to-let first of all. And we've got plus here and minus. What I want to do now is just quickly share with you the benefits and disadvantages of investing your money in a buy-to-let property. First of all, the advantages. Let's look at positively then. So if you put your money into a property and take out a buy-to-let mortgage on that property and rent it out, you're going to have a good return in the form of rent. You're going to have a good rental return. Now, the good thing about the rental return is you can index link it. My son, his property, he rents here in Cheltenham, and his landlord is entitled to increase his rent by the CPI plus 3%. What's that all about? That's about 13-14%. He can whack it up if he wants to, and he may well do if he's got a mortgage to pay, because the interest on his mortgage has gone up. The mortgage rates, we look on here, on buy-to-let now, so the percentage rates are going up, increasing. You may be on a fixed rate, 2 or 3 year fixed rate, 5 year fixed rate, but they come to an end, don't they? And the rates are going up now. So he needs to look at, balancing the books, rental coverage, that sort of thing. So that's the first advantage there. The second advantage is there's lots of demand. Demand for private rental is always there. There's a massive percentage of people that rent privately. Here in Cheltenham, for example, somebody puts a house on the market for rent. There's loads of people interested because there's a big demand for it. So that's good news all around, isn't it? Legally, you've got this lovely thing called the short hold tenancy. Short hold tenancy is a lovely document, which means that you don't have to have people for, hundreds of years or lifetime tenancies anymore. You can have a 6-month minimum tenancy if you want to. So you can get rid of tenants if you don't like them. And there are ways of evicting tenants as well if you want to go that route. The yield is particularly good, and that comes down to the rent, of course. The yield is the return it gives you. So if you invest your money in a property and that gives you rent, that's the percentage yield. And the yields are very generous now on these things. So you need to take a look at that area as well. But the big one, and I'll put it down the bottom there, is potential capital growth. Yes, you can have yourself an income profit, so long as your mortgage isn't too big. Your rent might give you a good income. But the capital growth is what they rely on mostly. Mostly house prices have gone up in the last few years. Will they come down? They may well do. I think what will happen with house prices is they'll stay pretty stagnant. They might move down a little bit if the estate agent gets a bit too frothy with their valuations. Because inflation at 10% means that if house prices stay the same, inflation goes up, house prices effectively are coming down. Whether we'll see a drop in house prices will depend on the area in which you live in. But again, it could fall. So that's another advantage of a buy-to-let property. Now, what are the disadvantages? Well, we've mentioned about the percentage rates. They are going up, therefore your costs are going up. There's also a lot of other costs to incur when you buy a property. Stamp duty, legal fees, estate agency fees, if you're selling, of course. There's all sorts of costs involved in purchasing a property, and that you can't excuse that as well. The mortgage interest that you're paying, if you're paying a mortgage on your mortgage or on your property, so if you're taking out a buy-to-let mortgage, you can offset that against the rent to reduce your tax. That's always been allowed, but you can only now do that at 20% tax at basic rate. So what I'm saying here is that if you earn rent, you've got to pay tax on that. Obviously, it's income, isn't it? But if you have a mortgage, the interest, you can offset that against the rent to reduce your tax bill. Now, you can only now get tax relief at the basic rate on that. So it's coming down, unless, of course, you take out a special purpose vehicle. If you invest in the property as a limited company, there's different taxes there as well. The big one, though, capital gains tax. If you sell the property, capital gains tax is 8% more than normal rate. So selling a buy-to-let property is expensive to do because you've got this big capital gains tax to pay as well. So don't forget that. It's also expensive to maintain a property. You've got to have all sorts of things like energy performance certificates. You've got to maintain everything, keep a look after it. It costs money to maintain a property. Of course it does. You've got legal responsibilities like the right to rent. You've got to check people out to make sure they have the right to rent. Otherwise, you can go to prison, I believe. There's some sort of laws involved in that area. So there's quite a lot of legal requirements as well going on there. So the main disadvantages is the costs and the tax relief is coming down. The capital gains tax is quite high. So again, you want to weigh it up. Now, when interest rates that you're paying on a mortgage are quite low, and you've got rent which is quite high, it's an easy one to work out, isn't it? You're getting a monthly income and you're probably making a bit of profit each month. And then coupled with the capital gain, that where prices, of course, have gone right up in the last few years, you're on a bit of a winner. But things have changed. The interest rate on your mortgage is going up. That means you're either going to put your rent up or you're going to make a loss each month. You're going to make an income loss, and nobody wants to make a loss. Yes, there's a capital gain, but if prices come down, there isn't. So the allure of buy-to-lets will start to diminish, particularly for small people that will have one house, maybe two houses. The professional landlords do it very differently, and they'll be looking at properties where they can get a higher yield, maybe a lower priced property that can still rent out at quite a bit of money, and they might do them up to increase their profits that way. Now, on the other hand, we need to look at shares. So let's look at share investments and just to sort of compare the two, really. So we're looking at stocks and shares, unit trusts, weeks, all sorts of different collectives of buying shares. So let's look at advantage, disadvantage of buying shares. First of all, if you buy a share, you will hopefully get a capital gain, because share prices do vary on the stock market, and it may well be that your price of your share will go up. It might go down, of course. The stock market is something we can't control, and it is geared towards the economy, recessions, all sorts of issues around that as well. But you also get dividends. That's the thing people forget about shares. If you got yourself invested in a particular company that's highly profitable, it will pay dividends. It pays you twice yearly income on top of your capital gain. So it's very much two bites to the cherry. Buy-to-lets give that to you as well. They give you rent and they give you capital growth. Shares do the same. So that's something to think about. The other thing is choice. You've got all sorts of choice about how you invest in shares. You can invest directly in shares. Of course you can. You can invest in a pooled investment like a unit trust. You can invest in ETFs, exchange traded funds, which allow you to spread your risk across the entire index. You can buy your own company shares, share save schemes, and get some tax reductions that way. So there's lots of ways of buying shares where you're not taking a huge risk because you're buying a collective, a whole spread of companies in a whole index, for example. Disadvantages of buying shares. Well, first of all, if you need advice, it costs money, advice fees. If you're looking for an IFA, a wealth manager, to manage your portfolio, he or she will take a percentage of your fund under management, and these are quite frothy. They're coming down. If therefore you want an active investment, somebody to actively invest the money for you, it's moving around, etc., then that's quite pricey. If you want to have passive investment, in other words, instead of a computer, base your investment on an index or stock market movement or something, then the advice fees are much lower. But there are advice fees involved. Not as expensive as buying a property, might I add, particularly if you're going for a passive investment. Now, without a computer, artificial intelligence do the investing for you. It's much, much lower. The other one, of course, is the volatility. They're much more volatile. The volatility in the form of values. You often hear about the stock market crashing by 5%. The stock market crashed by 5% by close of play today. The following day, stock market is up again after a terrible first start of the morning. They're up and down like a yo-yo, aren't they? So quite scary, really. Unless, of course, you've spread your investment across a whole wide field of shares, and therefore the volatility is not so much. But, stock markets go down, stock markets go up. Property prices have tended just to go up over the last few years because of supply and demand, whereas, of course, stock markets are very different. You have what's called a bear and bull, don't you? You've probably come across that one. A bull market is where people are buying shares all the time. A bear market is where people are selling shares all the time. So a bull market is good, bear market is not so good. So they call it bear and bull. I don't know why they call it bear and bull, that's what they do. So therefore, you need to look at maybe shares. Are shares becoming more popular? Maybe with high interest rates, with your mortgage costing you a lot of money now, the tax benefits going down, your rents going up, but not too much because people can't afford high rent, capital growth not there anymore. Maybe buy-to-let investing is not so popular. Maybe these people want to be looking at shares as investment. I will say, though, that this is probably for people who are part-time investors. They have money to invest, and maybe in the past they've looked at buy-to-lets, but now they're going to be looking at share investments. Professional landlords, where she has a number of properties in a portfolio, will remain on buy-to-let. Let's get this right, on the buy-to-let area, because that's the marketplace. It's their business that they're running. But things change all the time. So that's been an update for you on buy-to-let versus shares. That's been useful for you.